Hi, this is Joe Elsasser, President and founder of Covisum and also a practicing financial advisor. And welcome to another FinPlan Friday. Today's topic is charitable giving. Now, of course, the majority of charitable gifts are given in the old-fashioned way with a check from a bank account or cash in a collection basket or plate. And although it has a wonderful impact and it's absolutely positive to the charity, there are a variety of other ways of giving that might be able to have an additional impact because they carry some additional tax advantages. Two that we'll talk about today are the gifting of appreciated stock and donor-advised funds. Both of these techniques can be beneficial. So the gift of appreciated stock is interesting. If you are in a situation, or I suppose if your client is in a situation where they would pay capital gains tax. Now, that's important. If someone's in a 0% capital gains bracket, there's no additional advantage to gifting an appreciated stock. However, if they're in at least the 15% capital gains bracket, or maybe even the 20, and maybe even paying an additional 3.8% net investment income tax, those sorts of gifts can be dramatically more valuable if you can skip the capital gains tax. And the way in which you do that is by gifting the security itself, the appreciated security, directly to the charity, rather than liquidating the security first and giving the money to charity. The reason that distinction is important is if you give the appreciated security directly to the charity, it entirely escapes that capital gains tax. In other words, it creates an additional 15, 18.8, 20, or 23.8% impact to the charity for the same gift amount were it not given in that manner. And so that is an incredibly valuable technique for a lot of people who would otherwise pay tax on their capital gains. Now, the second technique is a donor-advised fund. Now, in the case where you're weighing between a donor-advised fund versus gifting appreciated securities, if you have highly appreciated securities and you're in a higher effective tax rate for capital gains, it's going to make sense to follow the former technique. But if you're not giving highly appreciated securities, sometimes it can make sense to use a donor-advised fund to accelerate gifts that you might give in future years into a current year where you might have higher income. So here's an example. Maybe in the year of retirement, an individual gets a severance package, and that severance package pushes their income tax bracket into a much higher rate than it would be in a normal year. And they also have additional cash, and they know that every single year they give a certain amount to charities. What they might want to do is donate a larger amount than normal this year to the donor advised fund in order to reduce some of that higher than normal tax bracket or tax implication of the severance package, and then spread out the gifts from the donor advised fund such that the charity receives them in exactly the same way the charity would have otherwise received them. The only difference is the tax deduction has a bigger impact this year. So that's two techniques that are unusual for many individuals, but they can add a lot of value if advisors are looking for those situations for their clients. Thanks so much, and we hope you'll join us next month.